Welcome to the latest edition of The Bull, the Bear, and You, as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. When the conflict with Iran erupted and the price of oil skyrocketed, the markets dropped. But since hitting their lows in late March, they have surged ahead, hitting new all-time highs. We discussed the reasons why. And even though AI has helped to push the markets higher, there are concerns on the horizon about consumer spending. And should you be picking AI winners and losers yet? We'll have some opinions coming up in The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting at the table, Kim Forrest of Boca Capital Partners, and one other seat is occupied by Michael Godwin of Fergasso Advisors. Michael is the Chief Investment Officer for Fergasso. Thank you all for joining me once again for The Bull, the Bear, and You, and congratulations to all of you. This is now our 50th recorded episode of The Bull, the Bear, and You. Somehow we keep going. I don't know how, but it's great. Thank you. Now, the last time we met, which is about a month ago, the markets were bouncing off their lows set on the last days of March. And then just boom, the markets exploded to the upside. In fact, after setting their recent lows in late March, the NASDAQ has gained 20%, the S&P 500 is up 13%, and the Dow is up more than 7%. Not only that, the NASDAQ, the S&P 500, and the Russell 2000 all set new all-time highs just within the last week or so. Now, we know the conflict with Iran and the price of oil skyrocketing caused the markets to drop, but the question is, why have the markets surged to new highs with the conflict still unresolved between Iran and the United States, and prices are still high for oil and supplies are dwindling? Somebody take it, please.
You know, I do think there's a lot of complacency in the market. However, it is corporate earnings season, and I think that people generally like what they're hearing out of corporate America. And the economic data has also supported an economy that continues to grow. I say that with some caution because there are a couple things that we're keeping an eye on. Obviously, the economic data, because with higher energy prices going on for as long as they have, I do believe that we're going to start to see some of that reflected in the data. And the other thing that we have to keep in mind, and potentially I'll be interested to get Kim's take on this, there have been a lot of corporate buybacks. So when companies announce their earnings, and we've seen this happen a few times this earnings season, they also talk about their buybacks, where they're buying back their own stock. That actually props up the price, because if you take shares out of the market, then when you do your calculation of shares outstanding to earnings, your ratios come down. So, it's kind of a way that you're, propping up earnings without actually selling more product or, cutting costs. So we want to keep our eye on that, because the question is, does that, and we've been talking about this for years, so it's nothing new, but when we continue to see such aggressive moves as we've seen to buy back stock, you kind of have to wonder, especially at these prices.
Now, you mentioned about buybacks. It just came over this morning with Bloomberg that corporate America announced plans to buy back $665 billion worth of shares in S&P 500 companies in the 4 months through April, and that is the most to ever start a year, according to some data that's been compiled. So maybe that is making a big difference here too, or at least part of the difference.
What's also interesting about that is the corporations, with all the money they're spending on AI, the rest of industry is not spending a lot of money on capacity. And that means they have this cash, and that's what they believe the best thing they can do with their money, I guess. And that, to me, it does not portend opportunity outside of AI for growth?
I have a probably more nuanced view of this. While I think that you can get tricked into believing that a company is stronger, better, and faster if you only look at a handful of metrics like PE when a company is doing buybacks. I think a lot of fundamental analysts are looking at the whole earnings release, and that would be margins and as well as organic growth. Just personally, I hate inorganic growth when it means they're just buying revenue. If you're buying a company, that's one way you can boost your revenue, right? Is to buy another company and suddenly, your revenue plus their revenue equals more. As long as it allows you to enjoy some synergies, like you're reaching people you wouldn't normally, and maybe the rest of your products grow as well, that kind of synergy, that's what I look for. But I think the big buyback just says that our companies have been incredibly rich in, having good margins and having cash on the balance sheet. And remember, anytime they do a buyback, the board has to agree to it. So the board's driving this. It's not just the managers driving it. The boards are trying to return shareholder value. And one way to do that with longer term holders is to give you the bigger piece of a pie, which is what a buyback is doing. It's making your slice of the pie, whatever portion of the buyback is. We're not going to do the math on that. It's too hard. But I think you get it.
So, Stacy, if you don't mind, I'll wrap this up in the next 10 minutes. Back to your initial question in terms of why the market has rallied so much. I think, for me, we talked about this a bunch earlier in the year. I think I've said it a bunch that the consumer is still very strong. The economy still look pretty solid. Unemployment rate's low. Consumers are still spending despite the now increase in inflation that we've seen here. The good news up till maybe now is we had globally, a big supply glut of oil. The world was awash in oil. And that's one of the reasons why I think oil prices have not gone up even more than what we've seen so far. That's going to come to an end, and probably arguably might have already come to an end. So if the war doesn't end somewhat soonish, I think you're going to see oil prices go up a bit more, gas prices go up more, and that could rein in economic growth and the economy, chugging along pretty well somewhat soon. But I also think the market thought that this war would be relatively short-lived, right? And we kind of just saw through what was going on in the Middle East. I mean, everybody kind of talked about it being, the president of the United States talked about it being pretty short-lived. And in that case, the market, generally, we talk about it being forward-looking, and it kind of looked through that a little bit. But I do think if it's not, and this kind of continues on, then you're going to see a bit of an economic strain globally to an extent. But even if you look in the U.S., though, you notice that oil isn't what it once was, right? We're just not that reliant overseas as we are, as we once were, which is a good thing. So more to be seen there. And then on the buybacks issue, kind of jumping ship a little bit. The only problem I have with buybacks, I think it's great as a shareholder value. But I think Warren Buffett would even say that, if you're doing buybacks because there's no other place for you to put it in your company to continue growing your own business, right? If you have a bunch of cash, a lot of people would say, all right, put it back in your business, continue to grow it. Well, we can't find places to grow it, so we'll just give it back to shareholders. That would kind of be the only downside I see to the share buyback situation.
Can I just tag on to that? But you look at what Warren did. He just squirreled his cash away.
Yeah, he certainly did. I'm not defending him.
You are somebody that is in charge of a company, and you're not following, your rules for other companies. Just, bad, Warren, bad.
Yeah, Warren has, I read over the weekend, I think almost $400 billion in cash. I think his book value is only $600 billion. But he's got leverage, and I think he's got assets of $800 or $900 billion. So I don't know how you do the math on that, Mike. That's your bailiwick. And the point is, he has a lot of cash, but he is the epitome of the patient investor. I mean, he has patience. I mean, he defines the word patient. They will spend that money when they find a reason that makes sense for them to spend it. And it'll be interesting to see what the new guy, now that he's theoretically fully in charge, does.
Yeah, he's still making a few changes here and there, I think, with personnel, but yeah, it's going to be interesting to see. I want to go back to something Michael said because, I'm sorry, Kim, is there something else you wanted to throw in there?
Yeah, just a real quick thing. The other kind of conundrum that I have with the whole cash hoard is I wonder, once you go to cash or once you squirrel that cash away and say there's nothing investable and the market's moved on, does he have the paralysis that we talk about so often and warn about going to cash? Just a thought. I was thinking about this over the weekend, honestly.
It's a good
Well,
question.
Yeah.
There's no secret that this market is trading at multiples of cash flow and earnings that are rather high.
But it's not just this market. I mean, this has been going on for decades,
Yeah.
over a decade now. But just it's a topic for another day. But okay, that's it. That's all I have, honestly.
All right. Well, Michael just touched on this. I want to get into it. And this is from a recent story in Bloomberg, and it quotes an economist saying, quote, "This is a split-screen economy. AI is doing well, and the middle class is squeezed." And they cite another economist who said that, quote, "AI can take the baton from the GDP standpoint, but the consumer is critical no matter what." I'm guessing that translates into the fact that I think you were alluding to, Michael, that if the price of oil continues to go up or AI is just as fine as it is, but the consumer doesn't have money to spend, we've always said that, 70% of the economy is based on consumer spending. So do you see this as a concern from an investment standpoint?
Yeah, I do. I mean, I'm kind of talking out of both sides of my mouth here a little bit. This, I think, is undoubted. It's definitely a K-shaped economy that we've seen here. I think it's fascinating to see that the U.S. stock market just hit a new all-time high not that long ago, and consumer confidence just hit a new all-time low at the same time. So consumers, broadly speaking, are very, very apathetic to what's going on in the economy, yet the market's hitting all-time highs. How can that's a conundrum that shouldn't really exist. The problem is, I think, the reason it's happening, I think, Stacey, is because it's a K-shaped economy. The top 20% of the U.S. consumers are doing very well. Stock market's hitting new all-time highs. Wage growth for them is pretty good. So they're the ones that continue to go out and spend and spend and spend. Whereas the bottom cohort of the economy are really struggling in an environment where gas prices are coming up quite a bit. Inflation's still well above the 2% level there. So at some point, you would think that would come to a head. I don't know when that is. I can't opine on when that will be, but that is a concern of mine going forward if things don't get easier for that bottom cohort of the economy.
Yeah, I agree. And I feel as though that could be sooner than later because of the lack of, I should say, the delay in the consumer and in the economic data really reflecting how the consumer is spending. It just takes a little bit of time to catch up if you think about it, especially because we live in a credit economy, so we don't pay cash for anything anymore. And, you go out and spend, and then the credit card bill comes in and it's like, maybe I shouldn't be spending as much. So I do think that given the fact that energy prices have gone up as much as they have, and it has, again, been extended, you can have all the AI in the world, but something we've talked about before is how are companies going to reap the benefit of AI? And there's a lot of ways it can do it, believe me. I think that there's so much opportunity out there in terms of productivity, but at the end of the day, we're still a 70% consumer-driven economy. So just the pure economics of, money in, money out has to work. So for us right now, as it relates to investors, this is a great time to be rebalancing your portfolios. We've seen, the market recover and doing a check-in to see how your new allocation looks. If you're a 60-40 investor and now because the markets have gone up, you're a 65-68% equity exposure portfolio, how does that look in terms of risk? And when you look at the complacency, the fact that energy prices have gone up, now may be, depending upon your risk tolerance, a good time to rebalance. I think the real question is this still a short-term conflict? Which it's fascinating to me, and I don't want to, this is not your political show, so we're not going to take it in that direction. But, what's being said and what's actually happening, there's a bit of a disconnect. So I'm not quite sure, how this is going to play out. And people should tune into your political show for that.
Thanks for the plug.
Carrie, what you're creating is a scenario of caution, risk management, and it's something that everyone should be doing all the time. And there are times to take risk, and generally it's not when everybody's happy. Which right now investors are happy.
Kim, you want to wrap this part up?
Sure. So I think a lot of is it ebullience or ebullience? It's one of those words that I read a lot, but I don't really use a lot. But anyhow, how about the overly happy market is based on all of this kind of crazy spending that everybody is anticipating for a very narrow slice of AI. Everybody's focused on OpenAI, Anthropic, Perspectivity, all the LLMs, because they feel like magic when you use them. It's a better search engine. It can, talk to you. It can entertain you, blah, blah, blah. But my point is this. It is not right enough. And at the current level of technology, it will always return wrong answers and hallucinations and drift off into weirdness because that's its design. Like, we're not going to get into the math of it. Remember, these are math models. These are not thoughts from a machine. Math models. Anyhow, in the long term, and I say like the 10-year mark, we are going to look back and have so many wonderful tools that allow us to not do horrible grunt work. But that is in the future. And I think the spending is going to be not all clumped in the next little while like everybody thinks it is. And I also think there's going to be really weird winners and losers. Because right now, if you would have said at the beginning of this year, or even the beginning of last year, check that out, January 2025, Intel would hit $100, AMD would be off to the races, and NVIDIA would be treading water. Would you ever have believed me? No, and nor should you have. But this is the weirdness of, as the models get used and as new uses are found, new technologies call for different mix of, the components. And I think we're terrible at forecasting the future other than by saying it's going to be different than today. Now, I think you should be invested in some of these companies, and I think you should invest in companies that are going to use the AI, but don't believe what the newspapers are telling you is going to happen. Just don't believe it, and invest with discretion and care.
All right, well, you don't want to read the papers. Sometimes you need information from somewhere, so we have to get it from maybe the corporate reports.
I just wanted to add on to that, because when I think back to even the beginning of the year and what my thoughts were about AI and this idea that, like, oh, we're just getting started, which we are, but this idea that it was going to take years to really see a significant change in our economy, I feel a little bit differently now. And it's really been through my own use of AI. I'll give you a quick example. I'm looking for a new screen for my fireplace, and I can't decide between two of them. So I upload the picture of my fireplace, and I upload the picture of the two screens, and I say, put this screen in front of each of these. Give me two pictures. As it turns out, after this was done, I actually went with the one that I didn't think I would go with. And it's just fascinating to me And that's really why I do think that productivity, it's going to be an interesting case study in the acceleration of productivity, in the impact that that's going to have, yes, on jobs, but I do think that there are many, many jobs that we'll talk about 3 years from now, 5 years from now, that don't even exist today, versus, how healthy is the consumer. And that's just a small, like in my little micro world, how I've used it. And even, when you look at marketing of companies and things that it can be used for, that is just, I think, going to accelerate productivity.
And as a corollary, I used AI to try to write a letter to my borough that wants us to change our street name. And that is an upheaval that would affect my business. It would affect lots of things, okay? And I used AI for this, and it wrote me a wonderful letter, and it used parts of the Pennsylvania code as like what you can and cannot do. And then I started validating it. It made up a completely new code. There is no 2402. I would have looked like a fool if I sent this thing, right? I would have been eviscerated. So it's stuff, and then I busted it. I said, hey, you made this up, and it went, ooh, sorry. That's it. That's all I got from it. Like, sorry. So, I've had to get legal counsel and all that kind of good stuff. So while I agree, there are many beautiful things that you can do, the stuff that we've been looking at and saying, well, we won't need lawyers anymore, not so, or at least not in this. Honestly, it made it up. How mind-blowing is that?
Yep. Oh, that's good.
No, it isn't. It's bad.
No, I mean your comments are good. I didn't say what happened is good. When we get off recording, I'll find out which AI you're using, so I won't use that one.
Yes.
I don't have any.
Well, actually, I used two, but one made it up. Yeah.
Okay.
Okay.
Well, you kind of touched on this, and I wanted to get into, and that is, of course, the big tech companies reported their earnings last week. Some gained in price in their stock, others lost a little bit. Is it too soon to begin choosing, which is, I think, what you guys all have been saying now, which companies are going to increase their revenues and profits by investing huge sums into AI?
Well, I'm just going to lead off here because I'm going to get my favorite of the big four that are the funders. That would be Microsoft, Amazon, Meta, and Google. And Google was our clear winner here because not only did they seemed rather mild in their only spending $1 billion more than they said they would, right? Instead of 35, they spent 36 billion in the quarter to build it out. Very good discipline. But they also had more users and actual people paying for the use. Like, hooray. The poster boy for how you should think about AI, or maybe how you shouldn't think about AI, is Meta. Now, Meta, I can't understand what natural use they would have for this. They're an advertising platform where we put our thoughts and family photos and other things up there, and people get money for, being, or they get money for advertising and using us as advertising fodder, right? I don't get why they're spending all the money that they're making in AI. I just don't get the use case. So I think you have to be very careful at this point about who wins and who loses, when they're going to win, and who should just drop out and maybe wait to buy somebody else's AI and deploy that on their website as opposed to funding it themselves. So those are my notes of caution.
It's hard to find a new up-and-coming company that's going to be a huge winner here. This is not like the 2000s where we're searching for the next Amazon, when Amazon had a market cap of 30 million, right? This is Google that has a market cap of, I don't know, $3-4 trillion. So everybody wants to find the next winner. It is so hard to come up and say, I'm going to pick this next small cap stock that is going to become the next, Amazon, Google, Microsoft, what have you. Good luck. Honestly, that's not what I do anymore. That's not my forte. It's just too hard of a game to play. In my opinion, it's hard to invest like that, I think.
Yeah, we've talked about in the past that, it is these big companies that are making the huge investments that have such a leg up on anyone else that's trying to, create something from scratch. And I think what we'll find is those companies that are creating from scratch, you think about what's the purpose of creating a business, they're just going to sell it to the big guys. So it is very challenging. And for those companies, those, startups, et cetera, it's risk return, right? And it's very, very hard to, at that level, pick winners, which is why for people that are successful in investing in startups and venture capital, the successful people diversify. So they invest in 5, 7, 10 different companies, and then one of them or two of them hit it big, and all you hear about are the ones that hit it big. You don't hear about the other ones that they invested in that failed. So, they make it seem a lot easier than it actually is to pick at that level.
I'm going to ask Kim this question, and then we'll move on. So as you analyze things, is it better to, in your opinion right now, invest in a company that is creating AI, or invest in what I'm going to call the hardware part of it, which would be the chips and that sort of thing?
So it's funny, in 2000, or 2020, not 2000, that was a very long time ago, 2020, when I was creating this strategy that I run mostly, I love software. I know software. I know what a good software company looks like. Love software, right? I used to work in it. At that time, and continuing to now, I have not found any compelling software investable companies, because I just felt that the growth, that big burst of growth, the newness factor, the deployment across the world has been missing. Nobody in enterprise software had the big idea that was going to change things. For example, ERP systems back in the Y2K, and what ERP is, it's a fancy accounting system. And then Salesforce in like 2010 came out, and people were like, yes, our salespeople should be using software for productivity and tracking and all that kind of good stuff. So I decided at that time that, maybe there's private companies out there that I can invest in, but, and I know they're going to come up, but I can't invest in them, so I'm going to put software to the side, but I know that everything has to be delivered through a chip, regardless of who's making it. And that was the focus of the tech part of that strategy, and it's paid off. And I think it's going to continue to pay off, as many of these companies, as you so rightly point out, that let's say somebody has a good idea, it generally doesn't become a new public company. It gets folded into an existing company. So for tech, and especially for software, I just don't see the big idea out there in a public company. So that's how I play things.
All right. Final question here. I'm not going to name names, but there is talk of one company planning to buy a much larger company than the buyer is. So my question is, if you are invested in either company, what should you do, if anything? Just sit back and wait?
Oh my gosh. Like, if ever two companies shouldn't get together, it's these two. And then, who are we talking about? Because I'm allowed to talk company names. GameStop. Yes, that unbelievably productive company that sells computer games at a store not near you is going to buy eBay. So, like, the idea of the 2000s. And yesterday, one of the weirdest interviews ever conducted on CNBC was done with the CEO of GameStop, who this is his big idea, to buy, eBay to get more, I don't know, to sell his computer games on or something. I've not got any idea. And at the end of the 15-minute interview with everybody asking him questions, it was pretty clear the CEO did not have a good idea. But that never stopped Wall Street from funding bad ideas. So buyer beware. How about that?
Right. Anybody else?
I don't have a ton to say. I mean, I kind of agree with Kim. If I don't even know if this deal is going to go through, Kim. I mean,
No.
the price I believe GameStop offered eBay was like $125 a share. eBay's trading right now at 105. It's essentially a 20% premium from where it's trading now. So if you have a high conviction belief that eBay will be acquired by a much smaller company, not even a competitor, then great that you can make 20% assuming everything goes through. But it's a high risk play that's going to happen. So in this case, you'd want to own, in my opinion, the company being acquired as opposed to the acquirer. I wouldn't want to own GameStop in one way, shape, or form or another, to be honest with you.
What it tells me is that there's a lot of money chasing too few things, because there are banks actually making loans on it. Banks actually making loans on these things. And that is a frightening thought, because every time that happens, it tends to not work out very well for the entire market, because you get these dominoes falling. And I'm not projecting anything because I don't know enough to say it. It's always a surprise when it happens, and when I look back on it, I'll say, why didn't I see that? Well, maybe I'm seeing it right now. Maybe Warren Buffett's right.
Go back to Warren Buffett. All right, we'll continue our look at investing in the economy in our future editions. Since you're watching or listening to this particular podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. Right now, thanks for joining us for our 50th episode of The Bull, the Bear, and You, and we'll see you again for our next episode, which will be number 51 in a couple of weeks. Thanks so much.